utilizing the whole strategy and school of thought of ICT and condensing it down to a simple edge.
It's a double-edged sword how much trading education is out there now, because 80% of it is trash. Like right now, there's 50 different people teaching the same thing. And then it becomes really confusing when you're starting, because you watch this guy, you get this dopamine hit when you watch it on his charts. It looks so good. And then what happens when you get in front of the market? It's not the same.
ICT concepts. We've had traders who love ICT. We've had traders who hate ICT. Well, today's guest, Jesse Rogers, otherwise known as Casper SMC, is one of the most prominent ICT traders in the whole industry, building a name for himself for not only making hundreds of thousands of dollars from the market, he's also helped hundreds of traders get funded.
You can't learn from just watching or getting lectured. You see these guys who have spreadsheets of thousands of trades worth of back tests, and you're like, oh, how much money have you made trading? Oh, well, I'm still testing it. People have this shit about mechanical strategies. And you know why? It's because they don't want to think, because it sounds easier than having to actually learn and have experience. If a trading strategy is truly mechanical, then why are you trading it? Humans aren't mechanical. No matter how much you backtest, how many spreadsheets you have, I promise you're not getting the same results.
I've heard Q banks, for example, kind of say 1% is for brokies or something to that effect. Even Alex G lately on my pod was just basically like, how rich do you want to be? What is your views on risk and tolerance to risk? What's a sustainable approach for you?
That's a great topic. So really easy way to do it. And this is going to be very high level.
Ladies and gents, welcome back to another episode. This one is I'm particularly excited for. I've been following Jesse, goes by Casper, for a while, and I've seen the detail you have in your trading career and how you explain things to such high levels that I don't have the luxury with every guest to go in detail in the way we will. And I hope and I pray this episode goes crazy, because I'm sure there's going to be so much value. So, bro, Jesse, thank you for joining me today, flying in all the way to Miami to make this happen. But for those few people that don't know who you are, just a brief explanation on who you are, what makes you you, and yeah, just your trading credentials.
Yeah, first off, bro, thank you for having me, Waqar. I appreciate it. It was a pleasure, man. It's finally nice to meet up. I know we've been going back and forth on WhatsApp a little bit, just trying to make something line up, but we're both busy. So nice to finally be here and make it happen. So for those of you who don't know me, I've been trading for 8 years. I've been in the trading, online space since like late 2022, 2023. I'll kind of just give a real high-level overview. So started trading 8 years ago. Took a long time to become profitable. When I started to become profitable, I was in a Discord group, ended up doing pretty well. They wanted to kind of elevate me to a coach or mentor role. From there, we did a lot of streams in Discord. And back then, that was when you could only have 50 people in a Discord, a video, right? Or a video stream. So I made a YouTube, started streaming live just to have enough people in there, and went crazy. Pretty much all she wrote.
So we've had on the show quite a lot of successful ICT traders. Just now I had with Kyle JadeCap, derivative of ICT, I think, for example, Andrew and FX. So plenty of qualified, successful SMC ICT traders. Despite that, there's still been a wide hatred or just polarizing with this topic of ICT. So it seems like you are very well versed in ICT. You're utilizing it. I just want to understand to what extent you use it within your own trading and just the reality of what it's like to be behind the scenes as an ICT trader and what it cracks out to be.
Yeah, so I use ICT pretty extensively. I think that the way to put ICT, it's almost like a language that you kind of have to write your own book with, if that makes sense. Like it's very spread out. It's very confusing and overwhelming. There's so many different moving parts that there's no way you could use them all. So he put out everything, and it's a mix of concepts from, other schools of thought. Like we know like turtle soup he didn't come up with. A lot of the stuff he didn't come up with. Okay. But he put it together though. So credit to him for that. And that's at the end of the day what I've done with ICT. And that's what every trader does. They take everything they learn from multiple different sources and then combine it into their own strategy, right? So, it's really simple. It's like fair value gaps, liquidity, and then time, right? The highs and lows of certain time periods. I believe that in business, trading, life, anything, like you have to have simplicity. Because if you don't have simplicity, every step of the way where there's friction, there's more likely to be error. So that's the big thing with me is just taking what actually resonates with you from ICT and then simplifying it into my strategy, right? I think touching on the point you said, there's like a lot of hatred for the ICT, community or whatever, but it's more of a cult than a community. And that's why there's hatred. Because any person that has created that form of a movement, they did so by being very polarizing, right? It's like similar to Tate. It's similar to a lot of people you see online who have this cult-like following. They had to create that hatred in order to have that.
The tribe,
Yeah, the tribe, right? So, and I think that was all intentional by ICT, 100%. He's very calculated. He knows everything he does. It's like a master marketer. But that I think is why there's the hatred on it. And I think a lot of it too is people, when they get very consumed by, the ICT, they find security in it, because the whole thing is pitching against retail trading, where people come in, they've lost all this money, and they feel at home. Right? Sounds more like a cult,
They
right?
resonate with the pain that he's, yeah.
And it's like, this solves it. I figured it out. All you dumb other traders. And then it becomes that, there's like an animosity in the air. Yeah, exactly. So it's like politics almost, how crazy it gets, man.
So within the realm of the concepts, I like the way you described it. It just seems like it's a catalog of confluences. It's a whole school of thought, but the reality of building it together is the journey, is the important thing. And that's what every trader has. You come to the internet and you say, okay, I could learn Elliott Wave, or I could learn Trendline, Fibonacci, SMC. There's so many things to learn. You try and learn it all in hopes of navigating it correctly. So you kind of have a condensed view of, let's say I start off with everything that is SMC or ICT, and then you sift through to find what resonates with you. So I want to hear that building block process, and the analogy of what you gave of the language. When I was learning a language, when I was in Spain, it wasn't effectively learned through the lectures or the vocabulary list that I was given. It was through conversation, and therefore immersion was the way I learned the language, as opposed to in theory land. So I want to kind of use that as an anchor to say, okay, how can you navigate ICT concepts, the whole school of thought, to the building blocks, then the immersion and application?
I think you sum it up in one word, and that's application. Because you can't learn from just watching or getting lectured. It's kind of like swimming, right? Like, let's say, or any skill, anything that's a amorphous skill, which is trading, you don't learn it just by the lectures or the direct education. Like if Michael Phelps wrote a book about swimming, and he told you everything you need to do in order to become the best swimmer, how to, all the form, like how to train your body, all these things, you could read the book 100 times. If you could jump in the water, you guys still have to learn how to swim. So that's how it is with anything, man. And I think that that's a big realization that all traders have to have when they go from, most traders start, they lose some money or they lose a lot, and then they get really reserved. And they're like, I'm going to do this right. I'm going to educate myself. But then they go they swing the pendulum too far. And they just start focusing only on, education. You see these guys who have spreadsheets of thousands of trades worth of back tests, and you're like, oh, how much money have you made trading? Oh, well, I'm still testing it, right? And I think that, it's just like learning a language. You have to go out and apply it, and you're going to mess up. Like if you learn a new language and you go try to speak it in that country or wherever that's the vernacular, you're not going to sound good until you go through it and realize where you make mistakes, and the constant iteration process. So, but it all comes back to, the reason that people make mistakes in trading is just because of fear, right? So they fear losing. So whenever you fear losing and you're just in this preparation mindset forever, you never go out and actually apply it. And people are looking for some mentor, some YouTube video, or some holy grail strategy that's going to push them to be successful. And I think that's the biggest problem with the ICT community, is that, and that's where the bridge of application, people don't ever really travel that because they're so afraid to lose.
There's a very common bridge that we see with all traders, regardless of the school of thought, which is you can be a backtesting warrior. You can make huge P&L gains in the simulators, and then you get to a live account and you just can't do it. Or you in the challenge process with prop firms, through the evaluations, you make it through. The moment you're funded, I've seen so many people blow it that week. I'm like, what just happened? So that kind of bridge is something everyone has to get over. I want to hear your thoughts on how to best achieve, from backtesting to live trading, how to actually be an effective real life trader.
Yeah, so to go from backtesting in theory to actually making money, number one, you have to remove whatever the goal is from a pedestal. Like if you're trading on something where you look at it like, oh, if I achieve this, I'm finally gonna make it. I'm gonna be able to make it out. I'll be able to make this money and it's gonna all be okay, right? When you place things on a pedestal like that, it puts everything you're looking at in a different filter where now you're nervous. And if you're nervous, it makes you stressful, and stress makes you stupid. So number two is you really just have to understand that risk and what you're risking is a big part of it. So let's just say, whenever I'm working with people who they just can't get over like the stress part, I say, okay, like if you cut your risk in half, do you feel that way? Well, if they say no, okay, cool. Well, there's your problem. And if they say yes, okay, cut it in half again until you don't have any kind of stress. Because it's one of those two things, right? Either you're valuing the outcome too high or you're putting more money than you should. Like if you're trading with more money, then you could just leave it, let's say the bar or wherever you're at, or the restaurant. Like you'd say you leave your wallet there. And if you go home and you lost that amount of money, imagine, an amount of money where you'd just be like, you're kind of upset about it, but you're not like panicking. Your rent's not now going to be due and you can't afford it, right? And that goes for trading a funded challenge. Like how much money did you buy the challenge with? And a lot of people, I think that they're not over leveraging themselves, but they are. Because truly, if you detach from the outcome and you don't really care, right? You don't value it like it's this, you've won the Olympics or something for getting a funded account or a payout, and you limit your risk to a point where it doesn't really faze you to watch a trade go to your stop loss, I mean, that's half the battle right there. I'd say almost more than half the battle,
So with regards to, I think every emotion in trading, you can boil it down to fear of an unfavorable outcome. Whether it's greed of not having, so you don't have enough money, so you get greedy, or fear of loss, or whatever it may be. And the way even an emotion is not wrong. The emotion is actually a signal from our body to say, hey, here's an issue. Our behavior towards it is what we have to modify. But upon this topic of risk, I've heard, let's say Q banks, for example, kind of say 1% is for brokies or something to that effect. Even Alex G lately on my pod was just basically like, how rich do you want to be? It seems like you're taking the opposite lead, which is, be in that conservative area. So what is your views on risk and tolerance to risk? And it's not about necessarily how confident you are. It's like, what's a sustainable approach for you?
So to be clear, I do agree with what they're saying in terms of you have to be more aggressive. But if you're learning, that's when I say, okay, because let's be honest, like if you're risking a lot, over 1% or whatever, it doesn't really matter how much you're risking if you're to that point where you're still nervous. You know what I mean? But now once you get to the point where you trust yourself, you've proven like, hey, okay, I know what I'm doing. Now it's just, kind of rolling with the punches and keeping it moving. Once you get to that point, yeah, you should risk more.
So out of the dozens and dozens of prop firms that exist in the whole space, who can we really trust? Whether they use slippage, whether they use types of drawdown, unrealistic trading conditions, every single prop firm has hidden tricks. So after thorough research and speaking to a lot of traders, Alpha Capital is definitely the best prop firm in the space. So apart from their no commissions, low spread, no slippage, great reputation, never denying a payout, because you are a Titans of Tomorrow viewer, you get a special discount on every evaluation just using the link or using the code TOT for Titans of Tomorrow.
And I also think risk is subjective to the account size. Like for example, if I go put $50,000 in a trading account, I'm going to risk more per percent than if I went and put $250,000 in a trading account. And that is dependent on an individual's financial situation.
Right.
You know what I mean? So it's a very subjective thing. There's no end all be all, like just risk 1%. Okay. But I think that when you're learning, the goal really shouldn't be to make money. And if the goal is not to make money and the goal is to learn and get used to it, okay, well, put yourself in an environment that's cohesive to that, which that is when you would cut risk, right? Because I think that's one of the biggest widespread lies that gets thrown around, because prop firms have brainwashed people. Everyone's like, oh, 1%, that's just what you risk. Well, why? People sit there and think, oh, this was what I said. Nobody's even thought about it,
Okay, so upon this topic of risk, so there's a few avenues or pillars of risk. One of them is going to be to modify your rate of return. So let's say you're going through the year, you start off to build your buffer. So you're conservative in the opening months. And then as you build the buffer, you can start to scale in more risk and try and get an exponential curve. So therefore, the outcome of modifying risk is to increase your rate of return. That's one area. The other area is modifying it in periods of loss. And some people would say, scale up your risk so you can get back into the positive. I don't know. Some people would say standardize your risk and just manage your emotions. Other people say cut your risk, but then the hole you're in, it takes longer to climb out of because you're slowly climbing out of it because you've reduced your risk. So I want to kind of hear your practical approaches on risk management, depending on the account situation as a professional, not just a learner in the beginning.
Yeah, it's a great topic. So I'm actually developing a software that does this because it is such an important topic. So really easy way to do it. And this is going to be very high level. There's 100 ways you could explain this, and it's always going to be subjective based on an individual's statistics, right? So let's just say if your average risk to reward is 3, okay, and you're at starting account balance. Well, you shouldn't let yourself lose more than 3 trades in a day. And if you go into drawdown, you should cut your risk, right? Cut it in half, let's just say. But if you go into a buffer, as soon as you get up into a buffer of, let's say you're up 3% on the account, right? So you're up 1 trade. Okay, well now you can risk more, right? So you could scale into risk. So the way that I do it is it's a pendulum, right? Like as you go into a surplus, you scale into risk, right? And this works very well for prop firms, especially futures firms, which is what a lot of people are trading. I know your audience is mainly Forex, yes. I think, but with futures firms, the reason that people find difficulty is because they're trying to have static risk when there's a trailing drawdown. So if the trailing, you see what I mean? So
Yes,
like
yes,
it's
yes.
important to take advantage of risk when you have it. So for, and your win rate is a big part of it too. Like let's just say if you have, a 70% win rate, maybe like a 1.5 R or 2 R, well, you're going to risk a lot more early on, right? And there's like 100 different explanations this could go down depending on what the win rate is, what the average risk reward and realized risk reward, not the position tool I'm trading.
Yes,
a lot of
yes.
people be like, my average risk reward's 5, but they trim like 3 times on the way
Yeah,
there.
yeah.
But that's the big thing is scaling risk as you build a surplus, and it's going to all be dependent on your position size and your average risk reward. But now, or not your position size, it's going to be dependent on your risk reward. But the other end of that is if you are in a surplus, there has to be a point where you start cutting off. Because if you risk more as you're into a surplus, let's just say, you can easily blow that up, right? And you don't want to just give back money. So what I like doing is if I am up 3 times my average risk reward, whatever that is, and that changes from around 2 to 3, at times it's a little higher, but usually in that ballpark, I'll stop if I'm up 3 times that on the week. Now, I'm not going to like exit a trade in the middle of it. Like I'll let winners run. That's another huge, huge thing that it's another topic, but a lot of traders don't do is let winners run. They just take profits at their target. When in reality, you should have a way of letting something go. Like if you read in like Market Wizards, the commonalities in every single interview, right? One of the biggest ones is just holding on to your winners longer. So yeah, it's another topic. I don't want to get off track, but essentially if you get up certain multiple of your average risk reward, you do have to cut if you're being more aggressive on risk or you risk giving it all back. And I think that's another thing too that people have to get better at is understanding when to push the gas, when to completely let off, and when to kind of like peel back on the gas. Like when you're in a drawdown, be a little bit less aggressive with risk, right? I don't think the martingale strategy is good. That's just me personally. Like I'm sure people do it successfully, right? But I think that when you're in a drawdown, like what else are you most likely, well, not most likely, but more likely to be in? Tilt.
So emotional trade, yeah.
Exactly. So I'm like, I'm going to cut back on risk if I go into a drawdown. And if it takes you a little longer to get back, so be it. It's not the end of the world. Market will always be there, right? But yeah.
When it comes to the reference I wanted to put of like increase your rate of return, and that's why we try to modify risk in a winning period or when you have that confidence in a certain setup, let's say. The other alternative, which is what I usually do, is I do standardize my risk, but I'll increase my risk through types of trades. So I have my A+ setups, but if my A+ setups are around a 75%, I know I can comfortably bring my win rate down to 50 and not feel bothered because I have a very respectable risk reward, let's say. So if I have a solid risk reward, I can increase it to taking counter trend trades, taking those B+ setups, let's say those hedge positions, and therefore take more riskier setups, but with standardized risk. So my overall risk is up, but not in the terms of risk per trade. What is your thoughts and reflections on that? Because a lot of people have many trade types. They probably haven't even defined what is an A+ and what is a subprime setup and so forth. Just have clarity on this idea of risk versus trade types and meshing them together.
Yeah, no, that's a great topic. So that's actually an interesting way of doing it. That makes sense because like you said, risk is multifaceted. So you can increase risk in position size or by the trades you're taking. What I usually do though is if I'm trading and I'm, let's say counter trend, we'll just use that term because I think that can be subjective forever. Counter what you usually would look for, like your higher time frames aren't necessarily aligning with the lower time frames. Like you have the idea, but it's a pullback, let's just say. In those times, I'm usually more picky with my trades in general. And that's just, it's not so much as I'll start, risking the same on them even if I'm in a surplus. Usually those are the trades that I either just don't take at all or I'll cut back in risk and put a feeler position on. So that's another thing that I do as well is like, let's just say, especially with futures, if we have a setup where maybe it has a very small stop loss where I'm like, let's say, okay, I have a trade entry that's very aggressive. Like we're at a pivotal point where I think that we could pull back, but it's not my normal setup, but the risk reward's really good. Like let's say it's like 10R, right? Because a lot of times you'll be able to get that if you're very early. I'll risk way less on the trade because I'm going to still net the same amount of average risk reward. Does that make sense?
Yes.
So that's how I usually handle those. Is I try to get a much better entry and I'll do a much smaller position size, right? And I use opening price a lot. So like 730 opening price, I'll extend it out. And I use that as kind of like a time-based level of premium and discount or a time-based like level.
Interesting.
Yeah. So,
not based on the previous impulse.
Oh, I mean, it's based on that as well. I mean, but that's more or less like, let's just say, okay, if the market opens and let's say I am bullish, like the 4 hours bullish, I'm waiting for the 15 minute to go bullish. And let's just say we go into the 7:30 open. And from that is the area I look at, okay, well, if my bias is correct, we should make a move here. And if the market starts rating highs, showing signs that it's still bearish, I'm like, okay, well, maybe if I'm wrong here, what's the next level we're going to go to? And since that's kind of counter idea, I'm trying to trade like a failure. I call it a fail flip is like the model I call it. But that's where I'll enter with lighter risk, because it's like, okay, well, usually when that happens, the market makes a pretty explosive move. When it's at an area where everything's aligned and you're just watching those lower time frames for confirmation and it's not giving it and it's just not adding up, you're like, okay, maybe I was wrong. You start looking at things in a different angle. But that's where I would look at it as more of a B plus or whatever, however you grade it setup. I know you use the low time frames a lot too, and it does tell you everything you need to know.
Okay, let's jump into that right away. What is your beliefs on M1 being noise or the low time frame in general?
That's all I trade. The M1. Yeah, it's all I ever enter on. I mean, every once in a while, I enter on a 5 minute, like I'd say 5% of my trades. And it's really, I don't really enter on it. I just use it. I might use it for a stop. You know what I mean? Like, let's say if we have a 5 minute fair value gap or a level nearby, I might use it as a stop. But the 1 minute's all I trade. I don't know. I mean, to be honest, whatever suits you, right? Like people make money on the 4 hour, people make money on whatever. There's always somebody out there. But I think it's ridiculous when people say M1's noise. I'm like, okay, like you lost money on the M1. That's fine. It doesn't mean it's noise.
It was a skill issue, probably.
Yeah. Okay, or like it's just like it doesn't suit you, right? Because some people just, and I think that there is a duality of things. Like yes, you have to like learn and kind of get used to things, but also there's a point where you might realize like maybe this just isn't for you, right? Like some people that are just really like, they have that kind of over trading tendency. And they just see the first inclination of something on the 1 minute.
Very impulsive.
Yeah.
Yes.
Maybe peel back a little bit. And if you revisit it later, whatever. But I think that when people say that, I'm never going to be the one. Like, I know there's people out there that are trading bull flags, making money.
Right.
You know what I mean? Like, there's no one right way to trade. I'm never going to be the one to be like, oh, that's a stupid strategy. I think that's just a sign of like immaturity, or people just use it for marketing. Like a lot of gurus will say that just to attack people. They try to build a cult, right? So
yeah. So when it comes to desires to go down to M1, the few reasons I can think of is like you're seeking more precision, meaning like a sniper entry or knowing when the market is going to flip. Accuracy is just having the correct zone or better win rates. Actually, accuracy is more a reflection of a win rates. You're more accurate in your outcomes. Another one is just more detail, more information. And I want to kind of hear your thoughts on the analogy I give is if you're trading only daily and 4 hour, you're watching a movie in 360p. But if you go down to M1, you're just getting a level of clarity, 8K Ultra HD, let's say. You're just seeing so much more that for me is crucial. And if I was forced to trade only 1 hour and above, I would feel like I would lose out a bit more or just not be able to do it in the same way. So I want to kind of hear what is the reasoning on going down to M1 for you and where you find its utility.
So basically everything you described, and it's less time. Like I don't have time. I run multiple businesses. I don't have time to trade for 5-6 hours a day. You know what I mean? Like I don't have that time. So if I can extract the money that I'm going to make trading a higher time frame, because it's all about risk reward, in an hour to an hour and a half, why would I not do that? That's the biggest one for me. And with futures too. With futures, the way that risk is, you know what I mean? Unless you want to, if I'm trading NASDAQ, if you're trading a 15 minute, I mean, those are going to be some, you're not going to be able to trade many contracts and be able to scale out as you'd like. Okay. But that's the main thing, man, is just the time. Like, I mean, yes, you get more opportunities, you get more clarity and all that, but there's no way that I would, I mean, I trade crypto. So like I do trade crypto on the higher time frames, but it's like 4 hour entries. And then I hold it for, like I've been holding a lot of crypto swings since right after the FTX stuff. Literally I've barely sold any on most of them, right? Because it's just, I'm using those higher time frames. I don't even look, like, I haven't looked at a Bitcoin 1 minute. Since probably like 2020, just because. And there's situations like that where I don't think it would make sense to look at the 1 minute on Bitcoin for me, for my strategy. I'm sure there's somebody out there making money, but I don't know how.
Fair enough. So when it comes to setups and building plays and so forth, are you proponents of having confluences, having good ideas that work, and then just coming to the market and based on what you see, deploying what you know? So kind of a more discretionary approach based on experience, market IQ, and information, and a bit of data, let's say. Or are you more on the side of, no, it has to be as mechanical as possible. You have to have predefined rules, predefined checklists, and then wait for the market to present what you want to see. Where do you lie on that?
Mechanical checklists of discretionary items. So the leaning towards the beginning. And what I mean by that is people have this shit about mechanical strategies. They just want something that's mechanical. And you know why? It's because they don't want to think. Because it sounds easier than having to actually learn and have experience. And people will sell them all day. And there are mechanical strategies that work. Like I literally put out a video backtesting a strategy over hundreds of trades that it did work. But like, what are you getting a year? Not the kind of returns that most people want to get trading. You know what I mean? And also, if a trading strategy is truly mechanical, then why are you trading it? That removes, humans aren't mechanical. Like no matter how much you backtest, how many spreadsheets you have, I promise you're not getting the same results. And if it's truly mechanical, by definition, then it would be coded.
Yep.
You know what I mean? So I lean towards now you need to have a mechanical checklist. Like for example, am I clear on the high? Because a lot of people say, oh, I have a mechanical strategy. What are your steps? Well, am I clear on the high time frame? Okay, define that. They're like, well, the daily bias is well, that's not mechanical, right? So I do think you should have like requirements. So for me, I have to be clear on the higher time frame, and then I have to be clear on like a medium time frame, and I need then 2 to 3 different things on the lower time frame to confirm it, right? Like I might use just a market structure shift if everything aligns with, but then it's like, let's say if I don't have clear market structure and then we tap into like the 7:30 open or take out like London low. If there's more things stacking up to the same thing, then I'm going to say, okay, cool. Well, I'm willing to put a trade on here. And that kind of goes back into before some of those trades where I'm more aggressive. Like if I'm just looking at it, and this is where discretion comes in. If I'm looking at it and you just kind of know sometimes, that's where I'll start putting a feeler in. And I think a lot of people are scared to do stuff like that because they get shoved down their throat all the time. Like that's like degenerate, right? But I always try to tell people, I'm like, look, do you want to make money or do you want to like make yourself feel good that you're being like responsible or something,
So I want to touch on this word, let's say intuition. Now we used a reference earlier of like if Michael Phelps had a book on how to swim, and it wouldn't be an effective way to learn, but also wouldn't be an effective way to teach for him either, because I'm sure a lot of the things he does is just subconscious competence. He doesn't know why he's so good at it, but if you were to sit and observe him every day, you'd pick something up that you didn't know. And that subconscious competence or intuition is a real thing. But I don't know where it sits in the market. There's this ability to have a gut feeling and actually be the right thing to do, to actually take action on that gut feeling. So I want to kind of hear your thoughts on, because you're adding an element of discretion into your system, and then naturally comes with emotions, naturally will come with fear and greed mixed on top. But then there also is power of, I've seen thousands of candles, I've seen years of trading data, I have this muscle that I've developed. How do you navigate intuition in trading?
Great question. So I think that this is where being an educator helps a lot and makes you a better trader. Because if you are educating people and you do have that level of intuition, you're forced to materialize it. And a lot of the time you won't do that on your own because you don't necessarily need to, but doing that is very powerful because you start realizing things that, like you said, were just subconscious. And once you materialize them and bring them to the front of mind, they become even more powerful.
Yep.
Right? So trading in front of people, like that's how I originally, I got, came up in the trading space. I just traded every single day in front of people. At first, whenever I would do that, you lose in front of like hundreds of people. They're like, you suck, this guy, then you win the next day, everybody's excited. But that teaches you a lot. Like that was really one of the things that like numbed me to caring so much about things, but it also forces you whenever you're taking a trade, if you're taking it intuitively, like, why did you do that right there? Well, this and this and this. And then you start realizing like, oh, I didn't necessarily realize that this was something that's so consistent in the logic, so it forces you to bring it to top of mind. And that's also why journaling is so important. Like I always tell people, backtesting, I mean, it's not useless. I won't ever say that. And if you're validating mechanical strategy, then that's where that hits. But if you're trying to learn how to trade, like backtest a little bit to prove maybe a proof of concept, but journaling is where you're going to learn, because journaling is where you reflect and you learn, why did I take this trade? That's where you materialize that intuition, right? So that's huge.
On this note of journaling, so it's a buzzword. It's what everyone's told to do, but I don't know if everybody knows how to get the most out of journaling. And the reference I gave previously, which I want to repeat, is when I was a university student and I was learning, I would have my lectures in front of me, or I've had the book in front of me, and I'd write everything down. And I would do it in a sense of condensation, or I'd do it in a sense of just writing helped me learn. So my format was, let's say, journaling or writing down the notes, and that was my learning medium. Other people would take the notes and they would condense it, and then reflect on it. And they'll just keep reading it again and again until it sticks in their mind. So some people learn upon reflection, some people learn in the act of doing. And I think in journaling, there could be either way, where some people journal just habitually and don't really do anything with it. So I want to hear your thoughts on what's the best way to journal that is truly effective. Is it upon reflection, and how do you reflect? Or is it in the act of doing to build good habits?
So I think it's a lot of questions. It's a lot of asking yourself questions, for me at least. And like you said, I think with everything, there's always going to be a better method for some people than others. But I think an important method, this is what I teach people to do. You start the day with a series of questions. And it makes you know what the real benefit of journaling really comes down to? Is forced awareness. Because a lot of times when you're learning, when traders are learning, they're just pushing buttons. They don't even know what the hell's going on. Like how many trades you take today. They're going to be like, shit. You know what I mean? You know what I mean? So it like forces you, and you also act different during the market. Once you have to go back and you reflect on something, you're like, wow, that was stupid. I'm not going to, you know what I mean? But I think you have to ask yourself a series of questions before, like, okay, well, what is my plan for the day? What do I think the market's going to do? Why do I think it's going to do it? What key areas am I watching?
As a trader, it's very simple. You have to find an edge, and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your backtesting tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need, the correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come.
Then after you're done trading, review your trades, see like, did this align with that, right? And sometimes it's not. That's okay. Like that's where you're going to learn. Ask yourself, what did the market actually do? Try to figure out why it did it. And if you sit there and spend an hour or two trading, try to spend an equal amount of time reflecting, right? So I think that's huge, is that. And because a lot of people, like you said, they don't journal the right way. They're like, oh, I got everything hooked up. I'm looking at my data. It's like, okay, well, if you're unprofitable, like, yeah, you have negative expectancy. Good job. Like, you know what I mean? It's not, there's no benefit in that.
Yes.
So it's about the review. It's about the reflection. And again, it's forced awareness. Like there's a whole scientific principle in this called the Hawthorne effect. So it's the same goes with measuring your calories, your macros, and weightlifting. Like if you go to a real personal trainer, it's like a weightlifting coach, they literally will track everything you're doing and go in increments up small as of 2.5 pounds. And they'll measure everything they're doing, right? Because the Hawthorne effect, what it states is when people are under being scrutinized, they are more, whether it's them or someone else doing it, they're more likely to perform at a higher rate.
Right.
So it's even if you're forcing yourself to be accountable and you're measuring things, scientifically the human brain will just act differently even while you're doing the thing. You know, so I think that's huge. And a lot of people say, trading's hard, or like trading's so hard, I don't know if I'm gonna be able to do it. And then if you really ask them, like, what are you doing? They're not even actually trying. They're just gambling, you know?
So the portion of journaling, I think, is definitely effective, definitely needed once you have a working strategy. Because then the purpose of journaling is probably to have this accountability, to have a dose of reality, forced awareness, and then also just analyzing, is it my edge that's the issue, or is it my performance that's the issue? And then you know what to address later on. But if you're in that stage of your career where you don't even have an edge yet, you're not even profitable, you're in that strategy curation phase, obviously journaling is not going to suit you too much, because you're just going to find out that I'm not profitable, and you probably already know that. So I want to hear your thoughts on actually going from learning, watching YouTube videos, watching podcasts and so forth, to actually having a semblance of a profitable edge. What does that window look like?
So I think there's a good saying for this. You probably won't be profitable trying to implement what you've learned in watching 100 videos. But you might be profitable trying to implement what you learned in 5.
Oh, I like that. Yeah.
You know what I mean? Because like it's like a leaky bucket, right? If you have a bucket that has holes in it and you pour water into it, depending on how big the holes are, no matter how much you turn that faucet on, it will always run dry at some point, right? So it's the same with you just inputting all this information and all this, education, right? If you don't just go out and just apply it and try to figure out, okay, well, what am I doing wrong? Maybe this strategy doesn't work. And that's another thing too, that I think it's a double-edged sword how much trading education is out there now, because 80% of it is trash. And whenever I was learning, I didn't really learn from, I tried a lot of different sources, but it wasn't nearly as many of, like right now, there's 50 different people teaching the same thing. And then it becomes really confusing when you're starting because you're watching it, you watch this guy, you get this dopamine hit when you watch it on his charts that it looks, so good. And then what happens when you get in front of the market? It's not the same. And that's where people are like, I just wish I could ask this guy a question, all that. But I think it's really about just getting honed in on a couple things that resonate with you, like finding someone that resonates with you because you're going to listen to them more, and then just getting off of social media a little bit and just giving it some time, like 15, 30 days at least of trying the same thing. And that's what I was saying earlier about it's so important to like risk such a small amount, because if you remove the psychological filter of it, then that's how you build that edge, because you're in the sandbox mode, right? Like if you're not in sandbox mode, then it's going to be hard to determine whether or not the strategy is the problem or you're the problem.
Yeah.
And so I think that's a big thing is just change. And also too, like in companies, right? If you always set a North Star, right? Whether it's leadership, companies, setting your goals, anything, you have a North Star, you put people on missions, and whatever the mission is what everything else works backwards from. Like if you set projections for revenue, okay, well, what are the KPIs that lead into those projections? Then you break those down. Now, if you set in trading, when you're first starting, before you have an edge, before you've built your psychology, before you are a trader, essentially, to make money, if that's your North Star, it's never going to work. And that's what people come in for, and they're like, what do you mean? Why would I not set the goal of making money? Well, you need to set the goal of learning the skill, and then the money will come. And learning the skill does not always equate to risking a lot or doing all these things. It comes down to, limiting your risk, finding something that works, getting a proof of concept, and then scaling into, like you said, after you have an edge, start to journal and start to find holes or find your strengths in your strategy. And whenever I say like that, a lot of people listening are going to think, oh my God, that's a lot. Well, yeah.
It's not supposed to be easy.
Nothing good is easy.
Yeah.
So
I like the sentence you said of like, instead of watching 100 videos and being like a self-help junkie or an information junkie, rather just focus on 5 credible and try and apply it and see where you get with that. And there's also that saying of like, don't fear a monk that knows 1,000 kicks, fear the one that knows 1 kick but done it 1,000 times. And to that effect, I know that in the markets, there's a guarantee you'll take a winning trade. You also guarantee you'll take a losing trade, but winners come. But the problem is when you're looking at who you want to learn from based on just winning trades, it can be quite misleading because even a dog can get a winning a trade. It's not a determining factor, let's say. So what I usually fall back and say is a restricted trader is a profitable trader. And I think I can probably judge someone's overall performance just by seeing a winning trade of theirs, because I know if they're entering that as a winner and they deem that a winning trade, then I know that their strategy is a bit fickle, let's say. So I want to kind of hear upon that, what is your restrictions? What do you like to limit yourself towards to have a profitable edge?
So I think the main thing is removing the need to trade. Like that's step one. Okay. And I know that's a very vague or broad way, but I'll get into it. So for example, like most of the time when you're talking about like being restricted, I mean, of course that is just limiting what is going to be the criteria for you to pull the trigger. So you have to get clear on that. Like a lot of times whenever I'm trading with people, everybody's, 1 minute market structure shift. Oh, and you could find, like you said, I mean, anyone can make money, right? Like let's say if somebody's sitting there and they say, oh, I think the market's going to go up. Oh, why do you think that? And it's just like, it's like a baseless thing. Even if you make money there, it doesn't really matter. So I think it's getting clear on your criteria. Like a lot of people don't have entry criteria, and really understanding that it's okay to not trade. Now, if you sit there for like a week or 2 weeks, never trading, that's the other end of that spectrum. And yes, you probably need to reevaluate. But a lot of people act like they're going to die if they don't trade for one day. Like I always say, people will say that they want to be a career trader, but treat every damn trade like their entire career depends on it, right? So I think that reshaping that mindset and getting clear on what causes you to pull the trigger and holding yourself accountable. And that's where journaling comes into play. Like, okay, let's say if you continuously see yourself going out of that criteria, whenever you review your trades, like, okay, well, why did I take this trade? Was it aligning with what I said that I thought was going to happen, or was it part of my strategy? Did it make sense? No. Okay. Well, if you see that happen like all the time, okay, boom, there you know your problem is, right? So now you know what to attack, and then just focus on that one thing. That's another really key thing too, is just focusing on the same principle. It's like a universal law, like focusing on a couple different concepts or things you've learned. Also, you need to make sure that you're focusing on 1 or 2 problems at a time.
Okay.
You know what I mean? Like it's like if you're in a business, let's say if you come into a business that has multiple different metrics that need to be repaired or fixed, do you just try to focus on all of them at once? No, of course not. You focus all activity or all energy on the highest leverage thing. And that's the same with trade. Like recently, for example, whenever I started reviewing a lot of my trades, I noticed that a ton of them went way farther than when I was taking profit. So then I say, okay, cool. Like I'm going to focus everything that I have on just holding my trades longer, like finding a way to do that. Like there's a criteria and a structure.
Okay.
And that alone has helped more than trying to go learn, some new fancy
strategies.
things.
Yes,
Yeah, exactly. So it's about identifying the highest leverage, highest ROI stuff.
Okay.
Yeah.
So these are the things I actually wanted to get into, which is when you have a strategy, you have two types, I want to put it, which is one is correlation based. So for example, a support level. I don't think the market reverses because of a support level, or head and shoulder pattern. I don't think the market reverses because of, rather the head and shoulder is a nice reflection of a reversal. So when I look at all of the strategies around, majority of them are correlation based. A trend line is a correlation, a Fibonacci level. I don't think the market is reversing because of the 61.8. Rather, the 61.8 is a nice bell curve, normal distribution. It's a statistical edge. Whereas when I see other things that are primary drivers, causations of the market, for example, liquidity, time, and so forth, that's where I like to hold my strategy because I'm always in tune with the essence of the market. And I know you're doing something similar. So I want to hear your main pillars of what is an effective building block of a strategy.
So I think, number one, you do have to pay attention to liquidity, but it's which highs and lows, right? That's really important. So I think an easy way to do it, and this is what I do, is I try to pay attention to like session highs and lows or quarter highs and lows, right? So like highs and lows of any defined range of time or previous day high, previous day low. So I always watch, has the market provided some kind of manipulation during the session? Because on every good trading day, you're going to get that. Now, whether it goes and sweeps out all, like a lot of people misunderstand and they look for it to just go clear out the entire Asian session and reverse. You don't have to have that much, right? But is it taking out some kind of time-based low? And also, is it trading into opening price? So a lot of it's time-based for me. Now, the reason I think that's powerful is because time, no matter how you map market structure, no matter what you deem as the right highs and lows, high and low of a certain time session, that's just that. There's no arguing that. There's no overthinking it. Opening price is opening price, right? So you add in those constants and then you use variables to kind of confirm that. So really it comes down to a key level, a narrative, right? Like based on the higher time frame, and then some kind of lower time frame confirmation. Right now, a lot of different pieces can fit and fill those roles, but it's having both of them or having multiple things aligning on either side. And then those are the trades that you're going to end up risking a little bit more or maybe scaling into. And those don't come that often. So essentially, it's just identifying where the market has given some kind of manipulation during the session, like where it's given some kind of move that has stopped a lot of people out, essentially, right? From there, it's just watching how we reacted. And another big thing that I do differently than a lot of people, it's like, let's just say you have your key level. For simplicity's sake, we'll just say a key level. It could be a lot of things. Once the market gets to that level, I then go to the lower time frames. Okay, I'm looking for one thing to happen, which is, sweeps in the lower time frame and displacement to the upside, like big energetic push showing that it's coming away from that level. But what happens when that doesn't happen? Most traders, they're just like, oh, I didn't get a trade. But think about it. You're trading from what? Higher time frame key level. You're trading from different areas of interest to different areas of interest, essentially, no matter what strategy you're trading. If you're wrong, and the market is clearly disproving that, there's another trade. Mm-hmm. So that was a big, big shift for me, was when I looked at things like that. And I started to take trades where, you're wrong on your bias, but you're able to quickly be nimble and quick on your feet to then shift directions. Right. That was a huge, huge step for me, was being able to do that and do it in a mechanical way, because that's a slippery slope, right? Because then a lot of people start over trading trying to do that. But as long as you have a structure to do it, it's because that you have to have frequency. Everything's a dichotomy in trading. You can try to overtrade, have too much frequency, or you can be too reserved, right? So that's in a nutshell. That's what I look for.
So the kind of things you're mentioning, and I know a lot of traders will just be like, I do this, and I end up with, I market roll out. So I have Asia high, Asia low, then session high, session low, previous day low, week high, week low, structure points, trend line, and then you have like 20 lines on your chart. Yeah. So how do you turn, and we also know, like, let's say we have a liquidity pool up here. Let's say it's a 4-hour high, for example, and then price goes up towards it. Therefore, internal price action is bullish leading towards it, naturally so. And then we start to clear it. So when we're in that clearing portion, one person would say, that's a bullish break of structure, I should look to buy. Another person will say, yeah, with the session volatility and whatever, it should be a buy. Other people will say, no, that's a sweep of a high and we should sell. So in these inflection points, I think the most important points in the market, which is around liquidity, how can you not get caught out in saying, this is a sweep, therefore sell, or this is a bullish breakout, I need to buy? How can you differentiate that intent in the market?
Two ways. So number one is that once you reach the structure point, did it displace past it? Like, was there an energetic push past it on your higher time frame? So let's just say, if you hit a high and you create a fair value gap through it, okay, well, it's probably going to continue, right? That's first and foremost. Even if the lower time frames confirm it, like, oh, well, the lower time frames, well, it's probably just going to go in that fair value gap and move to the upside again. Now, once you start running out of gas, like once you stop creating fair value gaps, that's whenever I start to look for a sweep. But then, like, let's just say if we didn't create a fair value gap through a point of liquidity, or it barely, didn't even close beyond it. That's the strongest sign for me. Then I would go to the lower time frames and say, okay, like, are we starting to put in bearish characteristics, right? Are the lower time frames signaling that the market's kind of rearing back? So it's a two-part thing.
So meaning, say, like, let's say we're in the portion of the sweep or the bullish breakout, we're unsure, and it's in a sweep of a supply zone, and you're seeing bullish fair value gaps. That's showing you that there is still buyers in control. Therefore, it doesn't matter what the sweeps are saying until you see the bearish fair value gaps develop, and then you'll look for a model to get in. Am I correct in saying
not
that?
a bearish fair value, the lack of bullish fair value gaps.
Okay, got it.
So sometimes of course anything's wrong. So like going back into that fail flip model I was talking about. Let's say if it comes into that higher time frame fair value gap, but the lower time frame isn't doing what a bullish market would do. Like, I always am asking myself, okay, like, what's the narrative? And then once I establish that, well, if that narrative's correct, what should the lower time frames be doing? Because if they're doing the exact opposite, okay, cool, you have a trade in the opposite direction down to the next key level. But yeah, it's essentially waiting for a very clear sign the market is going to reject that high or is going to, it is a sweep. Because that's another thing I think that I used to fall into a trap of. Once you learn this concept of liquidity, everything just becomes a liquidity. It's like, and that's very dangerous because, think about it. Go look at a chart. Like, anyone who's watching this, pause this. Go look at a chart and tell me on a higher time frame how many candles are part of a continuation versus a reversal. Way more, right? So getting this kind of like idea that you're just going to trade reversals, that's just the most toxic thing you can do. Because if, yes, you trade lower time frame reversals, they go with the higher time frame.
Yes.
You know what I mean? So many people, like, you kind of plot out the road, so to speak, on the higher time frame, then zoom in and figure out where the price almost needs to, like, go get fuel. I like thinking of like this, like, let's say if you have like a road trip, right? If you zoom in, you're gonna have to like stop at gas stations. You have to stop and get fuel.
It's funny I use the same analogy.
Really?
Yes,
That's crazy.
yes.
Yeah. I can't remember if I heard that somewhere or not, but it's just a good way to remember it because you don't just because you're stopping for gas, you're not changing up the whole direction, right? A lot of people get sucked into those lower time frames and everything's a liquidity sweep, everything's a reversal. Right?
So on this analogy, because this is the one I also use, you can get to certain points in the market where, well, at each stage there's probable roadmaps that could happen. And there are certain points where it's too confusing, and that's when you shouldn't take action because there's too many potential equally valid options. But then in other areas, there's only a few. Let's say we swept a 4-hour high, and then we're getting M15 bearish. It's like, okay, we had a higher time frame sweep, we've got that fuel, and the roadmaps therefore are more likely to be towards the bearish side. But then when we get to the day, it's like, okay, I know it should be bearish because the higher time frame is swept. I've seen a few bearish candles. Maybe I've seen rejection on the lower time frame. Cool, that daily bias for the next day is more orientated or more likely to be sellers. So I've got roadmaps there. But there's plenty of ways because you could have the Asia range, sweep high, and go lower like that. Or it could just not sweep Asia high. It could also sweep high, induce previous day high, and then go lower. So when you plot out all these roadmaps, even though the daily bias should be bearish most likely, the way to get there can be many, many routes. And usually what I do then is use markers of time. So okay, let's say checkpoints based on time. So therefore, time-based roadmaps. I want to hear your thoughts on time because you mentioned it was one of your key pillars on how you're bringing in time with this kind of intent and liquidity.
Yeah, so it's really like time-based liquidity and then also the opening price. So again, that's those two things. Like, a lot of people misunderstand like the power of 3 with ICT, like the whole like manipulation. They'll look for it to always like this be this perfect accumulation, sweep the whole one side of it, and then that's just easy. That happens is like, okay, well, it's obvious.
And I've noticed that gets ran again.
Yes,
so
always.
many times.
Yeah,
because
always.
It becomes such an obvious model that you get the equal highs, you get the fake outs, you get even some sort of rejection, maybe even a break of structure. And I've seen it so many times on London Open. That whole thing gets ran by 3-4 pips, and then the market moves. And I've seen that exact model so many times. Like, I've just labeled it a smart money trap.
Yeah. I've seen you use that term. I figured
Yes.
I have never seen like what you would have, but I literally in my head that name just made me think of exactly that, like where it's too obvious. But that same concept I was saying before with the fair value gaps, right? So let's just say like the market is, it's sweet or it hit these levels where it should reverse. Okay, well if it doesn't start, like if it first of all it creates a fair value gap through it, that's the sign. Okay, like it's gonna make at least one more low, So like, let's just say if the market, and again, it goes back to if the market's bullish, what should be happening here? If the market's bullish, like at that moment, and we hit into like the London low, and it just ransacks it, fair value gap in the 15-minute, like, okay, the market might not be bullish. Like in a bullish market, that usually doesn't happen.
Yep.
So then if we come to that fair value gap, I'll usually get a scalp down to that next low.
Oh, okay.
So little trades like that too, like with futures, especially trading the lower time frames, you can extract a lot. But it's all about understanding how to be wrong and still make money. Because a lot of the time, like daily bias, I think the reason that people screw this up all the time is they think that they just have to look at the chart the day before and be like, gun to my head, are you bullish or bearish? Oh, and if you switch out of that, you're being irresponsible. That's stupid, right? Like you should have contingency. You should have like, okay, well, you know, if I'm wrong on my bias, like if the market clearly is telling you you're wrong, listen to it, right? Because a lot of people too, they try to build ideas. Like for example, like let's say if the market, you know, they were bullish in the day, and everything sets up perfect, and the market, you know, sweeps out the Asian low or whatever, and it's just clear it's not reversing. They won't take a sell because they're saying like, I'm being reserved, I'm sticking to my plan. But a lot of times, if you can't do that, you know, you have to be fluid, you have to be quick on your feet, and be willing to switch up what you're doing. You know, that was a huge thing for me too, because I think everybody goes from being like a degenerate gambler to like they become too reserved, they become too rigid, and then you have to kind of come out of that shell and realize like, okay, I kind of know what I'm doing.
There's nuance in the market,
right? And just use common sense too. Like that's another thing. But yeah,
I want to touch upon now this word liquidity, which is, you know, I think a super important word, but it's maybe not well defined. So I want to kind of hear your thoughts on what do you see as these manipulations, these sweeps, and we've spoken about like the rejection, the intent, the fair value gap after it, but how do you define before? Like what is a true liquidity pool? Is it just session highs and lows or structural highs and lows, or do you see anything more?
So usually it's mainly session, quarter, and days, and then also weeks.
What do you mean by quarter?
So like 6 to 7:30, or 7:30 to 9.
Okay.
Yeah,
just
so
the highs and lows of that.
Yeah. So like Trader Day, like I didn't come up with that, but that guy started putting it. I mean, a lot of people said it's been out, whatever. A lot of people hate on it. I mean, it works. It literally does work.
Okay.
So it works very well. But I've always used session. Like that's always been what I've done. And then I started paying attention to the 6 and 7:30. I mean, dude, go plot it out, right? Like the charts don't lie. But that's a big thing. And then also like on a higher time frame, what I'll do is let's just say we're in, because everything on the higher time frame is going to be going either to a fair value gap or a high or a low. That's the way I look at it, at least, right? Of course, there's other ways, but for me, I look at it like lower time frame market maker model inside of that higher time frame fair value gap. So let's just say if we have two consolidations, and then you're expecting that last jab up, like I'll look at that high as, even if it's time based or not. Most of the time it will be, but I'll look at that as a valid high because there's context around it. But I think just looking at every single high and low, like as liquidity, is just like, anybody can do that. If it was that easy, you know, everybody would be doing it. You know?
Is the relevance of, so that brings me to the next question, which was, once we've identified valid zones, and there are many, how do you go about analyzing them? And specifically in futures, you have access to order flow and therefore real lifetime liquidity. I want to see how you utilize that to your advantage, whereas in FX, we don't have that.
Yeah. So this is another thing that is going to piss off a lot of ICT traders. Volume, like cumulative volume and all that stuff is very real. Like I know that's like a big thing, and like volume isn't real. Oh. Yeah, it's definitely real. Like, right, go, because what are you looking at most of the time? Like, what is a fair value gap? What they say is that it's, you know, an imbalance, and there's going to be orders left in that. It's going to act as a all that stuff, right? But like, go look on a chart, on like a TPO chart, it's going to be a single print, right? There's usually going to be a high injection of volume in those areas if it's going to hold. So with futures, you do have the blessing of having access to that kind of data, and a lot of people don't use that. That's fine. You don't have to use it, but it's monumental in terms of being able to hold trades longer, being able to trust that a continuation is going to happen. Like a lot of times, whenever you're holding on to a trade and you see increasing volume, you can pair that with what you're using in price action to tell you like, okay, like hold on to this trade a little longer, right? And just a one or a couple of those days, like over the last 20 trading days, 80% of the profit has been from 4 trading days, right? And that's simply because those days I held the winner. Like usually where I would cut, like what I do is something called price weighting. So I just named it that because it's a mechanical way of doing it. Let's say if you hit your target, right? So what I'll do is you have that area where that candle that took your target out. One candle before that, put your stop on that candle.
Oh.
and just keep doing that. Every time that it takes a new low out, you'd be mind blown at how.
It's a candle-based trailing stop.
Yeah. So it's one candle on your entry time frame. And I don't recommend using this in like a 15-minute or anything. It's for the 1 minute, because if you're using a higher time frame, it's going to be way too much of you're going to give back too much, right?
Yeah.
But if you do that, because think about it, out of, let's say, 100 of the last trades that hit TP, how many of those trades kept going? And then how many of those trades that kept going very viciously, right? Like a lot of traders, that is the difference in them being profitable and not profitable.
I like this. So this is going to be a trailing stop or break even, whatever, on candles preceding the move. But is it only on liquidity pools, or is it every candle as it follows?
So no, so it's only, so like let's just say you hit your target. Okay,
Yes.
cool. Until it forms another low, like just any swing low.
Okay.
Once it forms another swing low, cool. Once that is taken again, you move the stop back down.
So it's just all the lower highs in a bearish scenario. M1 lower highs that form lower lows.
Not highs, just candle, like the candle high. It doesn't have to be a swing high.
Yeah.
So like let's just say like if you made a low, you swept it, and whatever candle swept that second low, then you move it the one candle behind that. That way you don't give back, because it's not designed to, like, it's gonna get hit a lot. Like it's designed
It's
because
designed to get a little bit juice out of it.
yeah, exactly.
Yeah.
But sometimes you will see. I mean, like I like the other day I had a trade that was gonna be a 3R trade, ended up being almost a 10R trade because the market just viciously pushed past.
It happens all the time.
And that's what, see, it's not designed to make every trade go longer. And sometimes your trades you'll get less. Like I'm never going to be the one to be like, oh, this is the perfect way of doing it. It's just way better. Like sometimes it will come back on you a little bit, right? That's okay, because if you can increase your average risk to reward, like I know that my average risk to reward over the last 20 trading days is almost 8R. Now that's not usual,
That's solid.
right? It's not usual. But I don't want to sit here and say that that's usual, because it's not. But the reason of that is because of using that price weighting, right? So and again, like this goes back to what I was saying earlier. Like so many traders don't understand how to be effective, right? It's like the book, the 7 Habits of Highly Effective People. First things first. And what that means is you figure out what is the highest priority thing. And this goes in business, this goes in trading, whatever. And so many people have their priorities completely mixed up. They think that they need to learn more. They think they need to watch another video or another strategy or buy another thing, when in reality they know everything that they need to know. You just have to actually go in and figure out where the holes in your system are, plug them, and then watch everything change. And that's the easiest way to do that is, okay, like you said, most of the time when people are unprofitable, it's not like they're just winning no trades, right? So if you think about, okay, out of the last 100 trades, if I would have held the winners, the ones that did explosively win, just a couple of them probably would have made that trader profitable.
Yep.
You know, so that's one thing. Also the risk management we were talking about earlier, those two things, there's gonna be some people that are watching this podcast that hear that and they see the value in that and they go back and try to figure that out. And then there's gonna be the 95% of traders who just watch 100 more videos and say they're trying, but that's how you really pull the lever. That's how you move the needle and really see an improvement. And it's the boring stuff like that. It's the stuff that takes a lot of thought, a lot of patience, and really like redesigning your true strategy and not just a freaking market structure shift or something, you know?
We spoke about risk reward, and that's kind of the long short tool and what that shows versus return on investment, actualized risk reward. I want to hear your thoughts on maximizing that. I know you said leave a runner, but in terms of partials or, you know, all the liquidity pools that exist, hedging that you can also do, all these kind of characteristics you can have, how do you differentiate the risk reward and ROI?
So you still should be partialing out of these trades. Like for example, let's say if I have a main target, because the way I do it is I would look at my trade and where is like the actual end target. Like just looking at the trade itself. Right there, you're going to take 60% of the trade minimum, right? Then you would leave the rest as a runner. So you have to take profits. Like you do have to take, but I think that taking partials too early, like if you have, I can't remember the math of it, I don't want to say it wrong, but if you have it's like a 5R trade and people will take profit 3 times, they would have ended up with a 2.5R. You might as well just, like, you're making it harder on yourself. It's way harder to catch 5R than 2.5R.
Yes.
You may as well just cut it all there. So that's another thing that trading can help people with is realizing, you know, because a lot of people that aren't profitable, they could be with very small changes to what they're doing. You know,
so a big breakthrough that I had a year and a half ago that I've been quite vocal about is profit-taking systems, because you can have the same psychology, same edge, same technical, same everything, but the way you manage that trade can be make or break. It can be from non-profitable to profitable, as you said. And for me, what I found most effective was I used to be discretionary based on structure, based on X, Y, Z. I'd have exit points on targets, but as we know, a news event can change that, or just liquidity pools and there's so much changes that can happen along the way that what I thought on Monday, by the time it's Thursday, my opinion could have changed based on new information that's come. So what I started to do is just base it on fixed data points, and it ended up at 1 to 3, 1 to 10. It's just my fixed points based on the average stop loss that I have and the type of trades I take. When I looked at it a little bit further, I started to realize that what I'm actually doing is optimizing for the session volatility. The average movement of a session usually aligns with my first TP. So I want to kind of hear your thoughts, knowing that you're an M1 trader and utilizing time and manipulation and therefore volatile moments. Is there any correlation between that volatile session movement and overall profit-taking systems?
I would say there are days where if I'm looking at a session, I'm just like, this is one of those days. I just kind of know like everything, the stars are aligned. I'm like, this is, gonna blow, right? Like there's just, like, for example, another thing that I do, like let's say, and this is another thing a lot of ICT traders the pitchforks will come out on this one. If you have like CPI and it's bullish, let's say the numbers come out and it's supposed to be bullish, and you get a huge fair value gap that's on the 15-minute, I will literally bet you almost every single time you're going to get a trade out of that. Like, it's insane but people will be like, no, I'm going to fade it. It was just a manipulation. Now, you know what I mean? Like, but it's so when the news aligns with price, those are days that I look at for very explosive days. So getting off topic, the reason that I was bringing that up, those are days that I would look for more volatility. But other than that, and then when the higher time frames are very clear, I just look at it in a pretty mechanical way of like how I take profits. So I usually use 4 hour for like narrative, like overall, higher time frame. I look at the weekly and daily too, but then the 15-minute for like my kind of like navigation. So it's like the 15 minutes, like I'm trying to trade those price legs and then use the 1 minute to navigate them. But I'll hold past, like I try to like, because how many times does the market, make a bigger price leg? So that's where I'll use that 1 minute to try to price weight and hold the trade for longer. So I don't really switch up too much on that. But I'm sure that like there are ways to do that. It's just not something I've done.
What are your thoughts in general? I know I've seen a few stories lately on your opinions on prop firms. So I want to kind of hear your thoughts on the overall industry, the opportunity that it is for newcomers and the general health of the industry.
Yeah, so I think that it's a great opportunity when used correctly. It's not a long-term thing. It's something that you should use as a tool to grow your capital. And if you do it correctly, you can do just that, right? I think that you should go for payouts. You should be very aggressive taking your money. You should never try to scale up the account, right? Like get your, with Apex, for example, it's probably one of the highest ROI if you do it correctly. Get 50 accounts. It's around $2,300. The minimum payout you're going to want to go for is $40K. It's just a numbers game at that point. Unless you blow your account 20 times in a row and don't get a payout, if you're doing that, then obviously you're not ready for it. But as long as you can just get that payout, take all of it, okay, cool. Maybe buy a couple more challenges. But once you get to a point, people almost forget that real trading is still a thing. And then it comes back to that risk. Like, let's say if you have a 70K account, well, most people are brainwashed to think like, oh, I'm only going to risk, 0.5% or 1%. If you have that and you have an edge and you've proven yourself to be profitable with prop firms, you can risk more than 1% to grow that account more aggressively, right? Mm-hmm. So that's the way I think that people should go with it, is using it as a stepping stone. Now, as for the industry, so this is where, it depends on what company, but I think there's a book that explains what's going on right now very well. It's called Misbehaving, and it's just about economic bubbles and just how humans will be completely irrational in the face of an opportunity. It's the reason that markets collapse. It's the reason that crypto has rose and collapsed. And with prop firms, the barrier of entry is so low. And it's a business model that everybody is sold on this idea that it's, infinite money, essentially. Oh, dude, they look at it like they can start this prop firm and most traders are going to fail, so they can just take money from the losing traders and they're going to be able to make all this money. But they don't understand how business actually works. That's why you've seen all these guys that at one time were looked at like, oh, that guy's doing, 5-10 million a month. Well, that's what some of these prop firms were doing, and they collapsed. Why is that? Well, it's because people don't understand there is something called marginal cost with business. So whenever any business starts out, your profit margins are going to be much higher than as you scale. Now, some businesses like software have a very, very good marginal curve. They don't get exponentially higher because it's software. You're not having to scale into all your systems and employees and all these different things, or funded traders, which are the expense for props. But with props, they have at best, a linear progression of revenue and profits at best. Takes one thing for that to nosedive. But the marginal cost, marginal expenses goes up to the ceiling. And that's why it's like laughable to me when people talk about exiting these things or monetizing data or all these things that is just like a pipe dream. Now, some people are doing it correctly. I'm not saying that there are none. But when you have like very young people who have no experience in business starting what is effectively a casino, it's literally a time bomb, you know? And then another thing goes into it too. Like I've been posting recently, I posted some stuff like I have an announcement coming. A lot of people ask me about a prop firm. I will never start a prop firm because at the end of the day, like the way that I came up was helping traders, not taking their money. And yes, do prop firms give opportunity to some traders? 100%. But who are those people? They're the people that are exploiting the system, and those are the enemies of a prop firm. Because when you start a prop firm, you are incentivizing yourself to make people fail. That is the truth of the matter. Everyone can sugarcoat it. And you see all these influencers, like recently, there's people that they come out and they talk about all this, how prop firms robbed them, how all this, I'm this funded, you know, and then they go out and start a prop firm. And they're going to do the same thing. And it's because it shows the immaturity and the depth of these people have in the way that they want to make money. They'll do anything to make money, right? But the truth is you don't have to start that kind of business model to make money. You can make money by helping people. But what's funny is the people that make money by helping people a lot of the time will get labeled a scammer.
Yeah.
You know what I mean? But that's my take on it. Like I would never start one. Now, you know, has the thought ever crossed my mind? Yeah, 100%. There was a point where I wanted to start one. But, you know, it's just not something that I ever followed through with because you sit there and you really think about it. How did you come up? Like who you are, right? And I realized that my brand has been built on helping traders since day one and not, you know, who am I to go out, make all this content on, you know, helping traders and talk about all the stuff that I talk about and then go out and start a business that literally preys on traders. That effectively at some point will have to screw traders over to keep their doors open. That's what you've seen with every single prop firm. Every single one, either they have extremely difficult rules or they've built up such a big bank of money like FTMO that they have that leeway. But you've seen all these other firms that at one time were the favorite. They were the favorite, the hero. Then what happens? One bad software mistake, one bad PR event, and then that linear curve of profits nosedives. But guess what doesn't? The marginal curve. And then you get inverted, and now boom, you're insolvent.
Yep.
And it's so obvious. Like when you look at the business model, it is a ticking time bomb by design. Now, if you have other ways of monetizing, like they start a real fund or all these things, then that's different, right? But that's why you see every single prop firm you can go find where they've like denied people's payouts. And a lot of the times too, like you'll see a lot of influencers that they won't get denied because they have that, they're an influencer.
Yeah.
Right? So am I saying that prop firms are all bad? No. I think that you should trade them, but you should trade them in awareness of what they are, and that is a tool to grow more capital. You shouldn't throw your entire life savings into a prop firm. You shouldn't think that because you're a funded trader that you're now like have built a career. You're literally learning how to count cards. You're going in a casino and making money and building a bankroll, right? That's essentially what it is. So
I want to finalize the episode with seeing your brand grow very, very quickly is value orientated. You're not doing the lifestyle, you're not doing the flexing or the vlogs or anything. It's just pure education, and you've built a huge name for yourself. And I see you going very far, and it kind of brings me to the question of what is your overall goals with the industry? What do you want to do for traders? And what is the purpose of your brand?
I'm going to build and continue to build the largest trading education company that ever was. Because when you look at trading education, you know, you come into the market and you come into this through like what you said, lifestyle marketing, or you come in through some very beginner, base level education. Now, how many traders start with the same source of education that they end up becoming profitable with?
Yeah, I don't think anyone.
I don't know anyone, right? I don't know anyone. So why is that? Well, the reason is there's no clear bridge from getting introduced to trading to actually succeeding at trading. So I'm going to bridge that gap. And that's going to come from a variety of different ways. There's a lot of cool stuff coming soon. That's what I've been talking about on socials. Okay. I don't know when this episode's going to come out. Maybe it's came out by then. But really things are about to start changing, things that people haven't ever done before. And the key is just understanding, like you said, like having the North Star is very clear. Or like I said, having the North Star is very clear. And that is the North Star, is just creating the biggest trading education company that services people from day one all the way to becoming profitable.
There we go. Well, this is why the show is called Titans of Tomorrow. I think you've got a bright future ahead of you and a lot of things to conquer and achieve. And I think you're a force for good in the industry. So, bro, thank you for coming on the episode. A lot of value dropped. And hopefully it wasn't too valuable that I went over people's head and they can watch it a few times and made the most of it. Jesse, my man, thank you very much.
Waqar, thank you, brother.
Boom.
Appreciate it.
Here we go.